Thank you again for joining this presentation for my thesis. And the topic that I'm gonna present today is the relationship between the equity market volatility index and the performance of the information technology stocks. So today I'm gonna go through introduction, what my topic is gonna be about. Then I'm gonna present you key insights about literature review that I found the most interesting ones. I'm gonna walk you through my methodology that helped me to answer my raised hypothesis. And finally, probably the most interesting part will be findings and discussion, and as well conclusions of the topic itself. So to begin with, in today's increasingly complex market environment characterized by rapid information flow, unpredictable global events, and evolving economic conditions, understanding market volatility is more important than ever. And one critical tool to use to gauge its volatility is the VIX index. In other words, the kind of popularly said volatility index, and often referred to as the fair gauge. The VIX reflects the investor expectations for future market fluctuations. However, my research does not explore VIX specifically. It explores an alternative metric, the relatively new equity market volatility index, which I'm gonna call it EMV further on. And unlike the VIX, which focuses primarily on broad market sentiment, the EMV is emerging as a promising tool that captures specific and nuanced fluctuations. So within specific sectors, for instance, as IT. And this potential makes it an exciting topic in finance research, and specifically as investors face an increasingly volatile environment, understanding and accurately predicting these fluctuations become crucial. Though this thesis aims to shed light on the role and alternative volatility measures can play in understanding market dynamics. Sorry, it lags a bit. Okay. The primary goal of my thesis is to examine the reliability of EMV trackers in forecasting stock movements and to evaluate differences in how IT sectors are affected. So this research is particularly important due to existing gap in studies focusing on the relationship between the EMV index and the specific industry sectors. Well, specifically in this topic, IT. So most current research tends to focus on broad market measures. So for instance, as mentioned, VIX, which while useful, often overlooks the nuances and like more specific themes and complexities. And while focusing on the IT sector is essential because it's characterized by rapid innovation and also sensitivity to market sentiment and economic policies. So these findings offer practical tools for venture capital funds. So I've studied this topic because I work myself in one, and particularly in planning initial public offerings for instance, for IT startups. So by using EMV trackers to pinpoint periods of lower market volatility, these funds can better time public offerings to achieve favorable valuations, and also understanding like specific subsectors enables investors tailor their strategies, and they can also mitigate investment risks. So in this thesis, I used systematic literature review. I used Scopus and Web of Science and analyzed around 309 papers. And so the literature review underscores the value of studying volatility patterns and understand investor behavior, particularly through indices like VIX and EMB. And VIX was introduced in 1993, so measure short-term volatility in S&P 500, reflecting shifts in market sentiment and helping investors to adjust their portfolios. But more recently introduced EMB, which was developed in 2019, uses newspaper counts to gauge sentiment and has shown stronger predictive links to macroeconomic factors than the VIX itself. And studies suggest that EMB may better predict stock movements, making it useful for sector-specific analysis. And key methodologies included GARP model for time series analysis, granular causality tests, different regression models, and other models for comparing the EMB with sector indices in the S&P 500. So for the methodology part, shortly about collecting the data. So I analyzed monthly data from the S&P 500 IT sector. So focusing on subsectors as software, hardware, and semiconductors. And data was sourced from Yahoo Finance using the Python library. So first, I formulated 3 hypotheses in my thesis, and to accept or reject them, I use different models. So I use the models based on the literature review and after testing it and failing it for many times. But the GARC model was selected for its ability to effectively capture how volatility behaves in financial data. So I compared other models like eGARC and TAR model. So it offers a good balance between simplicity and providing a stronger performance. And so decision was further supported by performance metrics, so which collectively underscored its superior fit relatively to competing specifications. And in this thesis, in this thesis, I also, the GARC model was used to measure the volatility of IT returns, while EMB trackers are used to predict future volatility based on past data. And granular causality test, I checked how well past values of EMB trackers can forecast future IT stock returns, and VAR model looks at the relationship between the IT stocks and the EMB trackers. So it basically describes how each variable in the vector is related to not only of its own values, but also to the past values of all other variables. So moving on, the GARC model I analyzed if returns from IT stocks and EMB trackers can predict their volatility over the last 30 trading days. And the model found that the baseline volatility insignificant, but recent market shocks and persistent past volatility were significant. So meaning that the volatility tends to stay elevated after a spike. And this suggested that IT stock investors should monitor market changes to manage risk effectively. And for EMB trackers, the labor regulations was most predictive and showing sensitivity to market shocks, while the financial regulation tracker also responded significantly to changes indicating lasting effects. And the intellectual property tracker showed moderate responses, and other trackers varied in predictive strength, with some like agricultural policy showing like little significance. Overall, like the whole analysis highlighted like which policy areas most impacted the market volatility, aiding in for instance, risk management. So the results from the Granger causality tests reveal that different economic and regulatory factors as captured by the EME trackers influence sectors in distinctive ways. So, for instance, infectious disease, labor market affects all sectors because the assumption is that they reflect widespread issues such as pandemics or employment trends that impact the entire economy. And on the other hand, sector-specific factors like IP matters are particularly important for software services, given the sector reliance on the proprietary technologies. And for instance, similarly, macro inflation has notable impact on the hardware sector due to its influence to supply chain costs, or for instance, to consumer demands. And for instance, financial regulations is especially significant in semiconductors. So where changes in regulations can affect capital access and market conditions. So for instance, with this analysis, it provided insights for investment funds, so helping them to understand how specific subsector or specific economic regulatory development can impact that specific sector and how they could optimize their asset allocation. And with VAR model analysis of IT stock returns, so it showed that EME trackers impact returns at different lags. So the financial regulation tracker and the first lag has a significant negative effect, suggesting that tighter regulation may raise compliance costs for IT firms. And in contrast, the labor regulation tracker initially boosts returns likely due to perceived workforce stability, and through the effect fades to the second lag. And for instance, the IP, the intellectual property matter tracker shows a near significant negative impact, potentially due to litigation costs. And so finally, to conclude, so this thesis examines the volatility of IT stocks in the S&P 500, specifically the IT sector. And the findings rejects the null hypothesis that EME trackers have no impact, revealing the trackers. So particularly labor and financial regulation significantly influences these stock movements, and also shows that different IT subsectors react differently to EME trackers. So for example, the semiconductor sector is highly responsive to financial regulations, while the software and service sector is more sensitive to intellectual property changes. And regarding the ability of EME trackers to forecast the IT stock movements, the results shows mixed results. And labor and financial regulation trackers show significant predictive power, while others like agricultural policy have minimal influence, so probably suggesting that that firms shouldn't follow for this specific sector that in detail. Okay. So the insights from the thesis can shape long-term planning and risk management strategies within the venture capital firms by using the EME trackers to forecast IT stock movements. And this approach allows funds to make informed decisions on market timing and portfolio growth. And by linking EMB index analyzes the sector specific volatility in the IT industry, the study provides like valuable tool for navigating market dynamics and maximizing investment opportunities. And for the final slide, of course, the limitation and potential for future work. So while this thesis provides valuable insights into the relationship, it of course has some limitations. And so the reliance on monthly data may overlook finer fluctuations in shorter time frames, which could limit the depth of analysis. And additionally, the study does not specifically address periods of exceptionally high volatility. So, for instance, like financial crisis, which may have distinctive dynamics worth exploring separately. And also focusing on the IT sector within the domestic market. So this would be the US, and leaving room for future research to investigate the effects of like other sectors and other international markets. And also expanding the scope could yield additional insights. And thank you for the attention.